everyone for joining us tonight. It's a beautiful night. My name is Cynthia Asen. I'm joined tonight by Danielle Kinsey, my co-host. We're dealing representatives with Parvis Investments. We help investors access private equity opportunities beyond traditional stock market. It takes a lot to put on an event like this, and I'd really like to take a moment and thank the Parvis team, and especially Danielle, who really spent a lot of time organizing the event. So just a little round of applause for our organizers. So Danielle and I started last year. Danielle came along, and the two of us are working very hard to build a team that we can help people understand private equity investments. Just a little disclaimer before we begin. Tonight we're educational. This is not investment advice. Every investment comes with risk, and past performance is not indicative of future results. Please review and read the offering documents before you make any investment decisions. We're going to do a draw tonight for people in the room that hang around. Really, this is about understanding money and what you want to do with it. And the intention of this presentation is to help you understand private equity and what you can use it for to build your financial wealth. I'm just going to do a short story about when I started, for the moment that it changed my life. I'm going to take us back to a rainy night in Vancouver. I was in a conference room on the west side. I was in a conference much like this, standing at the back of the room, wearing the blazer that I'd done multiple showings that day. My feet were sore. It was very, very hectic. The market was volatile. It was unpredictable, and we really didn't know what to expect, but we were working really hard. I was exhausted. The speaker at the front of the room said something that really resonated with me. He said, every day you go to work, two people go to work, your money and you. And then he went on to say, the sooner you make your money work harder than you, the sooner you get your life back. Because really at that point I was thinking, really? Is this what life is all about? I'm going to trade my time and for money forever? My son was 2 years old, and I remember that was the shift, that was the spark that inspired me. I drove home that night thinking, how am I going to make this happen? And the honest part of it is, I didn't have any money to invest. We owned a home, we had a mortgage, we had a bit of registered accounts, but I still was determined to do that. And 4 years later, in 1996, we owned 7 rental properties. So this just didn't bring me income. It brought me options, it brought me choices, and it gave me the freedom to choose what I want to do. And so hopefully tonight you get sparked, you have a shift in how you think about investing your money. And that's really why we started this event, because today investors are wondering. There's a quiet question going on in their head. How do I create wealth without being on the roller coaster? How can I do that? What are my options? So we created this event to bring together 3 private equity investment companies with the plan to do that. These companies were carefully selected. They're not flashy. They're disciplined. They have strong, proven track records through multiple market cycles. They use a very robust due diligence. They know what the risks are, and they plan for them. They don't just know when the good things happen, what's going to happen. They know and how to deal with risk and how to mitigate it. They're also real estate asset-backed investments, which aren't really as volatile as the stock market. So they're a lot slower moving and have consistently provided strong returns to our investors. So this is about you learning. You're going to take away 3 things tonight. And it's going to be clarity. You're going to know what these investments are in plain language. You're going to have confidence. You're going to know how the returns are generated. And you're going to know how the risks are managed. and you're going to have connection. You're going to be able to meet the principals, and you're going to be able to talk to them. These are the people that are managing your capital, and you want to be able to ask them the tough questions and get the answers that make you feel comfortable, safe, and secure. So hopefully, our hope is that spark happens to you tonight, that something shifts, and that you think about investing your money differently. Because it's not just about investing. It's about making choices that allow you to grow your money so that you can live the life and have freedom of choice of what you do. So with that, let's begin. Our first speaker is Randall Warrington. He is the National Sales Director for Pier 4. Pier 4 is a company that buys multifamily residential in underserved markets. And they do a value add, a strategic value add, to improve and provide strong investor returns while creating quality homes for tenants. So welcome, Randall.
Hi, I'm not Randall, I'm Jackie. I'm the VP of Sales for Pier 4 in Vancouver. I'm taking his place. He will be coming up for the Q&A after. So thank you very much for Cynthia and Danielle for making this happen, and thank you for all of you attending this event. So before I begin, before I joined Pier 4, 5 years, I've spent about 5 years advising clients on stocks, ETFs, and I dedicated my time a lot finding the right product for my clients that is not really correlated with the stock market. And I have found something that is really interesting that I'm going to share with you about real estate investing, but non-correlated to the stock market as a whole. Sorry, it's not moving.
Yeah, I didn't think it would.
Okay. So today's presentation is going to split into 5 parts, but I realized that we only have 20 minutes, so I'm going to go a little bit faster than that. First of all, Canadian rental market has been historically tight. So if we're looking at the vacancy rate, the vacancy rate for purpose-built rental apartment for 2024, as you can see here, is 2.2%. And the national average for the 34-year is 3.1. So it is significantly below what the national average is. And with the housing start lagging behind the demand, Canada actually needs to build 3.1 million new units by 2030, and which is about 426,000 annually, and we're building nowhere near that amount. So there's a strong demand, but undersupply of the rental market here in Canada. And there's a lot more people coming into Canada than leaving Canada as a whole. Pier 4 target asset class is in strong demand, because if you're looking at CMHC data showing that, I'm gonna come over here, the well-established asset compared to the newer built asset, the vacancy rate is much lower in those established assets, which are 20 to 30 years old, and that is exactly what we are strategically buying in the local market. And the provinces to target, we're also very strategic because we're investing into Ontario, Nova Scotia, and New Brunswick. And if you're looking into the average rental growth in these provinces, New Brunswick and Nova Scotia, from 2021 to 2024, has been explosive. That doesn't mean Ontario is not a good place to invest. It is just soft right now, but it is an opportunity for you to go in. Once it's turned, then you will realize a lot of capital appreciation. Skip over that. So the fund itself, we have a weighted average appraised cap rate of 4.5%. We have 41 properties in our fund right now, a total of 2,041 units. Our occupancy rate is 96.77, is very, very high. and our targeted return or targeted distribution is 8%, distributed monthly. Our NAV price is $11.35, and our targeted return is 12 to 15. And a lot of our property management and renovation is done internally, so to minimize costs for our investors. If you look at our fund growth, we started in Q2 2020 with only 4 properties and 73 units. We reached 100 million in 2023 with 18 properties and 493 units. And right now, we're at 425 million under asset management. And we're having 41 properties and 2,000 units. Our DRIP annual return is 12.95, and our cash return is 12.13, and our 2025 annual return is 12.09. Sorry. This relates back to what I was talking about, looking for asset that is not correlated with the stock market. This is the range that we're in, 9 to 12%. But if you look at other asset classes or other funds out there, similar ones, even the mortgage real estate ETF, there's big fluctuation in their positive and negative return. And the global REIT, because of the market, it also experienced like 58% increase or negative, positive 32% and negative 24%. If you don't want to experience these volatility, you should definitely look into the private REIT market. So who's behind the fund? Our founder, Daryl Ashby, and our co-founder, Adam Ashby and Michael Ashby. Daryl has been doing this for over 40 years. He started doing contracting work for major landlord and REITs since 1989. And now his 2 sons, Adam and Michael, started the fund so that investors can invest along with them. Right now, we have 3 offices in major cities, 80 employees. We have our comprehensive asset and property management team, combined of over 100 years experience, and we have over 3,000 trusted investors. So our philosophy is to deliver consistent return, deliver affordable house for the locals, and build up relationship with each of our investors. We use the 3R strategy, which is to realize, revitalize, and return. We buy off-market properties by realizing the opportunity, and we renovate and revitalize the properties and buildings, and then we deliver the return consistently to our investors. Through that, with our internal renovation and renovation team, we can lower our historical average renovation cost to $15,000. But if you look at renovation in Vancouver or any other metropolitan, it's insane. You won't be able to get anything close to $15,000 for any renovation. And that translates to a $50 million fair market value gain in our fund. I want to stress on the next number there. It says 51.21 gap to market. That is the overall difference in the existing rent and the market rent in the local market. So when we acquire the property, we look at the gap to market, and those are opportunity where we can raise the rent and generate value for our investors in the future. Once the tenant move out, we go in and renovate, and then we can raise the rent. So that 51% is a downside protection built in our fund to protect your capital, okay? Because we all know that the rent can go up or down. When the rent moves down, there is enough buffer in our portfolio where we can still move the rent consistently for our investors. So I have a few real life example, what we have done in the local market. So this property we purchased March 15, 2023 in Kitchener, Ontario. It's a 46-unit property. We have renovated 16 units, and we have spent, perfect. We have spent $754,000 on there. You see the pre-capex and the post-capex picture. We have different tiers of renovation. This one, we have done suite renovation, security cameras, new entrance door, corridors renovation, laundry room, and intercom system. We bought this property for $6.6 million, and as of the end of 2025, our appraised value of this property is $10.71 million. So, and we have also increased the average rent from $920 to $1,307. So with that, we create value for our investors, getting cash flow and also capital appreciation with the value of the property. The second one is an Elmwood Drive, purchased 2023. It's in Moncton, New Brunswick. It's a 42-unit building where we have renovated 31 of them. We have spent $535,000. We have raised the average rent from $761 to $1,295. When we purchased this property, it was $5.6 million. And you can see the before and after pictures right there. Would anyone want to take a guess? How much is the appraised value right now? Oh, nope. $8.6 million for this property. So there's a big difference in what we do and how we actually generate value for our investors through these little things that we do in the property. If you have your cell phone right now, we have a QR code. We have two examples here for you where we have done smart conversion for our buildings. Where there are underutilized storage locker, we turn it into livable units. So if you can scan that, you will see our team in action. You'll see that we have turned storage locker into studios and the next one into one-bedroom suite. And that is significant because we would be able to gain revenue on the NOI where we can increase the appraised value for our investors in our properties. Do you still need time? More time for this QR code? No? Okay. Apart from just renovating, we are also environmentally cautious. So we will put in Energy Star appliances, LED lighting, high efficiency boilers, water sense toilets, and new building envelope, efficient building envelope as well. Our portfolio, you can see some of these pictures, is probably not something that you imagine. These are some of the older buildings, usually the same look with brick, with brick exterior. You can see that the gap to market is what I wanted to stress, because with that, we will be able to consistently deliver return for our investors because we can raise the rent once tenants move out. And you can see 93% gap to market, 34% gap to market, and 47% gap to market, where it is significantly lower than the fair market value rent, and that we can actually produce consistent return. These are some properties that are under contract. Actually, we have closed on the first one, which is $102 million. It's one of our biggest acquisitions in Pier 4 history. There are 9 buildings in this property where some of those land could be opportunity for future development or sell-off. That would be another opportunity that we consider, but what we do best is to buy and hold and manage the property for tenancy. We have talked about investing in different local market. We invest in secondary markets, so we do not invest in Vancouver, we do not invest in Toronto, and we invest into Kitchener, Ontario, Guelph, London, Thorold, Cambridge, Hamilton, Waterloo, Peterborough, and then on the Nova Scotia side, Dartmouth, Halifax, and Bedford, Moncton, Riverview. We are in 13 communities right now in 3 different provinces. So we have different classes that investors can invest into, and if you are interested in looking into, you can talk to Danielle and Cynthia about the details of our offering. We have our trust version, and we also have our LP version for tax efficiency. So if you want more information, we also have our OM where you can actually read through all the offering, the offering memorandum where you can look into the offering details more. As Cynthia has mentioned, there's risk in investing, and some of these risks are business risk, industry risk, trust risk, interest rate risk. There's a lot of different risks, and if you have any questions, please consult with Danielle and Cynthia. And that's it for my presentation, and I would open up for Q&A. I would also invite my colleague, Randy, to come over here. Sorry, hang on a second. Go ahead, please.
Your properties appreciate over time, and because of the renovations you put into them, do you do mortgage takeouts? Where you extract, if there's a difference between your cost and what the market is, there's value there.
Yeah.
Can everyone hear?
Repeat the question.
Okay.
If you want to
Repeat it.
the
Sure.
question,
With your name is? Jim. Jim's question is, with the renovation increase of the appraised value, do we take mortgage refinancing? Would you like to take that?
We haven't as yet. So after 5 years, we've refinanced probably, I would say, about 70% of the portfolio so far as it becomes mature. We have not taken that profit off and used that to further buy more properties. Most of what we acquire now is from inflows from capital coming in on a monthly basis. We'll use that to buy the properties. At some point down the road, we will probably take some profit out to use that capital, depending on what the gain is for each property. We are getting, and I don't exaggerate this, on a weekly basis, calls from institutional investors, high net worth individuals that want to buy parcels of our properties. So we have only sold 2 properties in our history. So we're not at that stage of our growth yet. We are still in accumulation phase. We still want to get this up to the $1 billion mark and then obviously grow it further from that standpoint. So, that answer?
Do you guys realize the CMHC NOI?
Yeah, I can do a U-turn. Yeah, so 90% of our financing is CMHC. So we go through, sorry? It's all on CMHC.
On their MLI program or just on CMHC?
That I would have to get back to. A majority is just on CMHC, so it's not specifically on MLI. So I can get the breakdown of that further. I don't have that off the top of my head, but most of it is CMHC on their platform.
Mm-hmm.
And I noticed that most of your portfolio is in rent control second markets. So how do you deal with tenants who aren't moving out but are under rent control?
Yeah, so good question. So our turnover in our overall portfolio is about 25% on an annual basis. We do not reno evict. We're okay with that number, 25%. That allows us to have a natural flow. The other caveat to the secondary markets that we're in, the benefit, if I could look at it from that standpoint, the secondary markets are more affordable from an individual standpoint. So if I'm 30 years old, young couple, trying to save money to buy a house, if I were to live in Toronto or downtown Vancouver, that's going to take me 15, 20, 25 years to save up that deposit based on what my rent is. In the secondary markets, because the rent is lower, cost of housing is lower, that turnover where literally the tenants will stay 3, 4, 5 years and then they'll go buy their own property. So we get that natural turnover. So rent control has an impact. We tend to not raise rents unless we get that turnover. Mm-hmm. And that's typically what we do. And once we get an empty unit, because we have the vertical integration where our contractors and all our renovation teams are in-house Pier 4 employees, we've got a 31-day turnaround time to get that renovation done, get it back on the market at the increased rent price. So it's the background of the founders comes into play here because they've got everything down to a meticulous science as far as what the cost of a door should be, what the cost of a kitchen renovation should be, what flooring should cost. We have national contracts on everything we use for renovations. That time frame is very, very strict as far as maximum 35 days. We try to keep it down to 31 so we can get that rented out after 1 month. Good.
We often get a few questions from investors, and we'll probably just run through those. And it seems we have the fund managers here. Jackie Randall, where do you see the biggest risk in your strategy today, and how are you mitigating that risk?
Good question. Biggest risk right now is there is rental compression in some markets. What we're seeing, again, that's why the importance of that gap to market comes into play. If you don't have a very robust gap to market in your portfolio, if rents go down 5-10%, you're pretty much already underwater as far as your NOI, right? The only way I can increase NOI in a property is either increase revenue or decrease costs. So if rent's going down, I'm decreasing my revenue. We have that buffer where, because our gap to market is so great, because the buildings we're buying are typically off market, so we don't get in bidding wars. We have, for lack of a better, we have a reputation now for these types of buildings where brokers are calling us on a daily basis saying, would you look at this property? Would you look at this market? Have you looked at this city in this province? Yes or no? And we'll go down that road. So I think interest rate risk is a big one right now. I think, again, with market sentiment and then the market headlines that are out there right now, I think to your point earlier and to Cynthia's point, thank God we're in the private sector and not on the public space right now, because the whipsaws that are happening on public REITs is not happening on the private side. Right? So to us, it's really interest rate risk, and that's, again, it's mitigated. We know what we're doing there, so we expect it. If we think rates are going to go down, we have this in play. If we think rates will go up, we have this in play. So we've got contingency plans on all strategies from that standpoint.
And part of that would be a little bit, can you speak to how your debt is structured and how that relates to sensitivity
Yep.
rates over the next 12 to 24 months?
Yeah, no problem. So our debt is staggered. Obviously, we're not going to have 10 buildings maturing within the next 3 months. Depending on the building, so that $100 million building we bought, that was all CMHC financing. That will mature over the next, some deals we do are 3-year terms, some are 5-year terms. I think there's maybe 2 deals we have in our portfolio that are 7-year terms. And we will stagger, obviously, as those come through. Once we get under that 12-month term to those mortgages, obviously, if it's a good time to renew it, we will turn it over quickly. If it's not, we'll hold it to maturity, then renew it at that point. Okay? We are in the process of working with CMHC to get preferred lender status with them. So again, that simply gets us a faster funnel to get approvals, faster decisions on funding from their standpoint. So we're able to make decisions on the buildings we want a little bit quicker.
And as far as the difference between public and private, maybe you can speak a bit to the returns and how that's different between the two markets. And from the 12 to 15% that you were targeting, just key drivers that get you there, and what the risks are. If not, what would be the risks if you're not going to hit that?
That's a multi-layered question.
Yeah.
So
3.
the difference between privates and public, to me, honestly, it's just volatility, if I'm being blunt. If you're in a public REIT, you still have the assets backing your investment, but the NAV that you're seeing and the stock price that you're going to buy into on those public REITs, as I mentioned, depending on the headlines on a day, that's going to go up and down, 3, 4, 5% on a daily basis. I say it bluntly, we don't care what the markets do on a daily basis. Does not matter to us. Yes, on a macro level, how the Canadian economy does and how these regions do globally or going forward will matter on the price appreciation. Realistically, for our standpoint, what matters the most is what we do to the building internally, how we manage it, and then what we can get out of that from the rent growth on that side. If it appreciates in 5 years, fantastic. If it appreciates in 10 years, okay, so be it. As long as we can keep ticking that rent up, the average rent of those buildings, then our NOI is going up. right? And because we control the whole vertical stack as far as any renovations that need to be done, any property management side of it, we can control the cost on that standpoint as well. What was the second part? Sorry.
No, I think you hit most of them.
I did?
Just,
Okay.
talk about your target return is.
Okay, so yeah, so the 12 to 15%, again, that's appreciation. So all our properties are appraised by third-party appraisals every quarter. So it's not an in-house appraisal. We're not deciding what our properties are worth. We have Avison Young, CBRE, and Colliers do our third-party appraisals. So once a year on the anniversary of the closing, when we take purchase of those properties, we have an in-place, on-the-ground, in-person appraisal. The other 3 quarters are what they call desktop appraisals. So they look at the market, they look at comparables. What have they done in the last 6 to 8 months? And then they price them based on that. So every single quarter, we're getting a third-party independent value on our properties. That drives the NAV, that drives the return. Okay, the 8% distribution every month, that is just distributed as a return of capital. So layman's terms, we're technically delivering your money back to you. It's the most tax efficient way we can do that. So from a tax efficiency standpoint of getting income in your pocket, it's the most efficient way we can do that.
Yep.
Yes, when you eventually sell out and you want to take your profits from the whole fund, yes, you'll have to deal with those tax implications at that point, but from a distribution standpoint, is the most efficient method we can use.
How liquid is the investment? Can you get, how
Good question.
easily can you get your money
Yeah.
back out?
So we have monthly liquidity. I will caveat that it takes a 60-day notice to get the money out. So it's a rolling, every month you can get your money out, but you've got to give us 60 days notice. So technically it's a rolling every single 3-quarter kind of thing. The reason we do that, again, to be blunt, kind of how I do it, you're buying real estate. It's not a liquid asset. Now, I will say this, these buildings are much more liquid than buying a high-rise tower in downtown Vancouver or downtown Toronto, right? So typically for these kind of buildings, if we wanted to sell it, we would be looking at probably between 15 and 30 different buyers that would probably want to buy those purchase offers. If we were looking at a high-rise tower in downtown Toronto per se, at the price tag that those buildings cost, you probably got 3, 4, 5 institutional buyers that would look at it, right? Which is what some of the market right now is dealing with, some of the competitors. They can't liquidate some of their buildings quickly. We can liquidate these probably within 90 days if we really wanted to. Like I said, that we've had, so our Moncton portfolio has got about 5 or 6 buildings now in Moncton. We have had offers 4 times this year so far, different investors that want to buy the entire Moncton portfolio office. Right, so we can, the smaller, more nimble buildings can get out quicker than the big high-rise towers.
So that's the liquidity side, and which ties into, you want to speak about the redemption schedule and how that works for anybody who's not as familiar with private equity and
As far as the DSE, that kind of
just
thing?
the minimum time invested before taking money.
Right,
out,
so
the
depending on
redemption
what purchase offers, or offer, oh my God, purchase, what am I trying to find?
fees. Which series?
That's it.
Yeah.
Depending on what series you look at, there's a different redemption schedule.
Yeah.
F class, you can get out, that's fine. The front end class is a 3-year kind of, it's called a lockup, but it's basically a DSC structure. So obviously we want you to stay in longer than 3 years if you want to. We'd like you to be there, but it's a penalty if you redeem early. If you're taking the distribution and reinvesting it, we have what's called a DRIP program. So if you do reinvest that distribution, you're buying units at a 2% discount. So you're automatically making a 2% return on your investments there. I should mention if I can, right now for the end of April, we have a promotion on right now for a 3% bonus unit. So if you were to put, say, $100,000 in, you're going to get $103,000 worth of units. We have a portfolio list of properties we're looking at that I would say is probably 25 properties deep right now. For us, this market that we're in right now is a phenomenal opportunity for us to purchase some of these buildings. That's the reason for the promotion. Our liquidity is, the benefit for us is we're small. We don't have the time that some of the market competitors have had in the marketplace, that we don't have the institutional investors, we don't have the family offices that have hundreds of millions of dollars with us. So we're not getting the demand from a one-ticket redemption that could penalize the whole fund. And that's really what has caused a lot of the issues that are in the private space. Okay.
Perfect. We have one more question at the back.
Just one more. Why would you not take mortgage refinance or debt from the bank or entities at a much lower rate than 8%? and versus giving 8% to us and also giving away the equity part, right?
Yeah. Yeah.
What's the math behind it?
Good question. Right now, we're just trying to accumulate the properties and grow it. We're not trying to. I wouldn't say we won't take money out. Like I'm sure, again, that's other side of the business I don't have exposure to. I would say that we're not looking to do that on a regular basis. So when we refinance, we're just trying to refinance get the mortgage like we do with the home price, right? I'm trying to get my mortgage down as low as I can so that we can then keep recouping as much as we can down the road. So when that NAV keeps going up, when the property value goes up, eventually when they do decide to sell, then we've got that much more cap gains that we can just roll into the next properties. So I think there's one property I'm aware of from our CEO that is in discussion right now to liquidate. I don't know if that'll be a Q2 thing or a Q3 sort of decision where we finally sell another building. Once we do that, then that cash would obviously be used then to look at the next opportunity. Can we get more upside out of, call it Peterborough instead of Moncton? Is there more growth coming in Peterborough because the 407's there now? The GO train's gonna go into, Peterborough going forward. Does that create population growth? Is that the demand side? So all those factors we'll look into, and we will use the capital obviously as we can. We're just not in that mode where we're looking to take the capital, because then essentially your mortgage just keeps ticking up with the property value, right? And what happens if property value goes down a little bit? Then we're back underwater. So we want to create a bit of a buffer first, and then let the properties appreciate on the growth. Good.
I think we're gonna wrap up the questions
Okay.
unless there's any more, and obviously Randall and Jackie
Be
will
around.
be in the room to answer any questions, as well as Cynthia and myself.
Good.
So thank you,
All right.
Randall and Jackie.
Thank you very
Thank you,
much.
guys.
Thank you.
MetroPoint is a mortgage investment corporation focused on lending against residential real estate here in BC, with a strong emphasis on first mortgage and capital preservation. They take a very disciplined approach to underwriting with rigorous due diligence and a clear focus on risk management behind every loan. What's unique about MetroPoint is that the principals you see here, Suki and Gupinder, are the ones directly managing the fund. They are deeply involved in every aspect of the business. Historically, much of their capital has come from long-standing relationships, friends and family, repeat investors. So we're fortunate that they're here now opening up this opportunity to all of us. So please welcome MetroPoint.
Thank you. This is actually, we've been in this business for 50 years, and this is our very first presentation. We basically raising our money, friends and families, colleagues, clients. We are CPAs. We were in public practice a long time ago. So you can always interrupt me if I'm not talking. This is my very first, I've never done public speaking in my entire life. I can talk and crack jokes, but here we go. So, again, my name is Suki Gill. Our partner is over here, Gupinder Lally. We are representing MetroPoint Mortgage Investment Corporation. Our focus is fairly straightforward and very simple. Delivering consistent income while protecting your investor capital through private real estate lending. Yeah, thank you.
So you can just push that down to get the slides.
Thank you very much. I appreciate that. Now, how we focus, what I'd like to walk you through today is not just what we do, but how these opportunities do exist in today's market, and how this could fit in your overall portfolio. All right. So to understand that, we need to start about what's going on, like what's happening, like what is this gap? And the gap is like right here, right now. So not all banks are going to lend to borrowers. And the reason for that could be timing, could be restrictive policies, and just slowing down of fund deals. So in many cases, it's not because a deal is bad. It's because it doesn't fit in a lot of these institutional current lending box, as we call it. For example, we come across this every week, pretty much every day. A borrower may have a strong asset, solid equity, and a clear exit strategy, but the timing's never there. The timing isn't right. They need this money in 3 weeks, 4 weeks. And simply, the deal won't move. That doesn't mean the deal's it's not available. It's not dead. The deal is still there. So these borrowers are going to leave the banks and other institutions, and they're going to move into the private market. Saying that, so what happens when it's in the private market? There's an opportunity. Let's see if this works here. Oh, it's pretty nice. I like this. I haven't seen this yet, so I apologize. So there's going to be a shift into the private market. Now, by saying that, you're going to say, well, why, the move away from traditional lenders into a private market, and there's an opportunity that's created. That's where our investors come in for this opportunity. Now you have a strong real estate brand, you have an asset, obviously everything's asset backed here. And then all they're looking for is capital, and they want this money quickly. That's all they're asking for. And since now that gap is being created, the opportunity is there, what you're looking for now is you're just trying to find out what are the key reasons for this opportunity. One of them is obviously every deal is backed up by real estate, straightforward. We're not lending on unsecured properties. We're not lending on a business. We're not going to lend on some capital out there, some company that's selling inventory. We're only selling on hard assets, and that's all we're lending on. This isn't a one-time condition. Everyone knows the mortgage industry. You guys are pretty sophisticated investors. You understand that we're not going to come in and just have one deal out there. We have, how many deals do we have right now?
82 or so.
82 deals, yeah, give or take. And these deals are actually very short too. And that's a bonus for us because we can actually shift and we can change if we need to, if markets do change and the conditions do change in the market. So when you combine all this, the strong assets, good security, high demand, you get sort of this access for this opportunity, as we call a MIC. So does anyone know what a MIC is? Some of you do or you don't. Does anyone not know what a MIC is? Okay, so a MIC is basically it's a mortgage investment corporation. We pooled capital investments all into one account, and then your money is basically distributed over 80 mortgages. That's the basic general concept of it. The money that you're going to make is basically from mortgage interest rates. That comes back to our pooled fund, and then it's distributed to you. So basically what you are doing in a simple term, you're the role of the bank, but with a higher rate of return. Instead of typically making a fixed rate of 3 or 4%, you're going to make somewhere close to 7 to 9%. And that's where the gap is. That's where we help out our investors. A little bit about ourselves. We're a BC-based lender. We started in 2011. A little backstory to this is we actually were going to start much earlier. It was with the help of my late father-in-law. He was a well-known private lender in BC, and he kept recommending that I start this MIC. I didn't know what a MIC was back then. I was in public practice. I was with my two partners here, and he keep pushing it. And he was in his late 60s at that time, and he's been in the lending business since the 1970s. Taught me a lot about the business, but one thing I never got to show him was how we started this MIC. With our experience, we have some core values that we follow. Our strengths come from our ability to actually move quickly. There's only about 4 to 5 of us. All of us are CPAs. While we still maintain a very strict underwriting value. That is our most important thing. That's actually our biggest key factor. We have a lot of strong relationships in the market due to our expertise, due to the fact that we know a lot of brokers, underwriters, bankers, development companies, builders, construction industry, and so forth in British Columbia. And of course, like I said before, speed is our biggest factor here. We're not chasing every deal. These deals do come to us. How many deals do we get in the average of every week that we have to look at?
7 to 10.
Yeah, I try not to look at any of them, but yeah, 7 to 10 is what we get every single week. And usually, how many do we do in a month, if we do any?
10-ish.
Well, if we're lucky, yeah,
Yeah,
yeah. If they turn out,
We want to do 10.
yeah. So that's basically what we are. Our investment strategy is fairly straightforward. We have a conservative loan to value ratio. Right now, what are we at? Averaging about 68%
For what?
of our loan
62.
to 62%. Yep. He's the numbers guy. So, we focus on short-term loans, so that means your capital, your money is quite liquid. 6 to 15 months is our short-term loans. We don't go past that. We will renew again and again, but we'll have with new appraisals and so forth. And we have our borrowers. We have to vet them carefully. We look at not just their asset, we look at their experience. We'll also take a look at what's the exit strategy of every loan. It's not rocket science, but it's a lot of work. You know, we need to get this out. We want to make sure you're taking, you're going to buy a house. Okay, that's fine. Where did the money come from? That's fine. What's your exit plan? Because we know you're not going to be able to pay 11% for a whole year. What is it like? And usually it's a story that we understand. New immigrants, people that have got their money, but they haven't got their financing because there's a gap, or there's a bridge loan that they may need. So there's a lot of various factors that we do look at, and then we do follow them. Once the loan's done, we're actively monitoring. We have a really good software that we spend a lot of money on, and all of us, all 5 of us, are always looking at these loans all the time to make sure that there's no market fluctuation, there isn't any issues or any problems. It's really important that we kind of keep on top of this, and we're not passive lenders. We're not brokers. We're far from that. We do like our brokers, but we have to be very, very independent from all of the money that we're lending out from the brokers, because they will sell us a great story. But we got to run through that fluff to make sure, well, what are we exactly looking at? I'll give you an example, something fairly straightforward. This one was done in 2024 or 2023. I think it was 2024. We started this loan off. Typical Surrey residential property, value was at 1.25. That's not the house, because I wish that was a house. So we got him a first loan at $850,000, which is a great loan. And it was a 68% loan to value. Those are that's on the average of what we do, just for our investors' capital safety, and of course, the minimizing risk. And that rate of return was 10.5%. Now, if we were to do that same loan now, one, it'd be much lower. The property value will probably be around the same of that property, but the actual loan itself will probably have to reduce it due to market situations, bank situations, and so forth. Detailed numbers, I'm going to bring up Grupinder.
All right, so since Suki's kind of gone over the operations of what a mortgage investment company is, how it works, I'll kind of go into how the investors come in. We need the investors to make the fund work, right? So we don't have $88 million of our own money. And this is obviously very important to investors. What are our target returns? So we're anticipating over the next year or so, our target return to be anywhere between 7 to 9%, likely towards a 7 to 8. Our focus on the properties that we are focusing on has changed from development type properties to single family detached homes. The reason for this switch is we find that this asset is safer. Everyone needs a home to live in, preferably owner occupied. Nobody wants to lose their house. And the reason for the rates to come down is this is a competitive space. The banks want these properties, other private lenders want these properties, and other mix too. So we're competing hard to get these properties. And at this point, given the economic uncertainties, the real estate market all over the place, we find that it's okay to bring down the rate a bit, have safer properties, and preserve capital. Having said that, this chart shows the performance since inception. So we started out in November 2011. It started out as, like Suki mentioned, we are CPAs. We have a public practice firm. And this started off as a side business. We thought we'd just do this on the side, make a little bit of money, fund money, but It's much more involved than we thought. So I left perhaps around 2015. Suki followed about 2 years later. So as you can see, the rate, so what we're here for is stability, consistency. The rate of return is very consistent. Our average rate since inception is around 8.5% or so. Last 5 years, I think it's 8.6. So as you can see, it's very consistent. Oh, there you go. I was trying to calculate in my head. So there you go. It's very consistent rate of return, and that's what our investors like. That's why they keep reinvesting. And if you, going back to the other slide, we, ignoring the first 2 years, that's when we're getting ready, set up. In 2020, you see a slight dip to 6.6, and as we know, that's the year COVID. Given the uncertainties and everything around that, we had held on to cash. We didn't invest it. And that's still a fairly decent return at 6.6%. Nobody lost their money, nobody lost principal, and in fact, they made money. So, like Suki mentioned, we're a small firm, but we've done quite a bit of business. We've raised performance. We've raised about $150 million, slightly more from investors. Most of these investors are family, friends, business acquaintances, or prior clients from our accounting firm. But now that we've kind of exhausted them. So I kind of like to joke around that when we approach Suki and I, they see us, they kind of walk away. They're like, these guys are gonna ask for money, so we got to go. So that's why we're here. We're with Parvis to expand our network. Since inception, we've funded 363 mortgages. We for a total of $258 million. And right now we've got about 650 shareholder accounts. These can be non-registered, TFSAs, RSPs, RESPs, the retirement accounts. And the typical investor is all over the place. Some have as low as 5,000 with us, and I believe the highest investor has 3 million. And obviously, the most important thing is risk for investors. What is the risk associated with this? And some of the stuff I'll be kind of saying over again. Suki talked about conservative loan to value. Overall, our fund is at a 62% loan to value, meaning if the total market value of the properties that we have loaned on is about 100 million, we've loaned 62 million. So we've got that roughly $38 million gap, which will account for some arrears. If property values fall and we've got to foreclose and stuff, so we've got that cushion there. It's secured by real estate, as Suki mentioned, and defined exit strategies. When a loan comes to us, we want to ask the borrower, when are you leaving us? We don't want you with us forever, because it's not healthy to pay these high rates of interest, right? In terms of risk, we've got strict policies and procedures in place, which are in the offering memorandum for you all to read, and we follow them each and every time. When a deal comes in, we first of all vet the broker. Who is this broker? Because, nothing against brokers, but some of them have been known to kind of make up stuff, right? So the broker, the borrower, who is the borrower? We've got a software, as Suki mentioned, which does a deep dive into the borrower, which needs to be done for AML procedures anyways. Was this borrower involved in something shady or not? And sometimes, surprisingly, stuff does come up. And some people have similar names, so that's a problem. That becomes an issue, right? So that does come up, and if there's any red flags, we just don't do it. We just move on. And why Metropoint as opposed to other mortgage investment companies? We feel, we're a small firm. There's 3 partners, 3 staff. We can get things done fairly fast. 2 CPAs tend to be conservative anyways. There's always somebody that says no, which is fine, and we don't try to convince the other partner, we should do this deal. We move on because that's a hunch somebody has, and we move on from that deal. The most important thing is keeping our investor funds safe. Why on an alternative investment as opposed to the public market? Stability. As the slide prior or the previous ones showed, that consistency, roughly 8.5% since inception per year, is fairly consistent, and that's why our investors keep investing with us. And how would we fit in your portfolio? I mean, clearly, as the dealer reps would say, we don't want to be the main thing. We can't be, perhaps 10% of your portfolio, you know this is going to get you 8.5% roughly, or 8%. You don't have to worry about that. We pay monthly distributions. Roughly, very few investors opt for cash distributions every month, but if they do, it goes straight to their bank account on the 10th of the following month. Most of them are drip. And common questions that everyone has. We've talked about risk. One is liquidity. You know, if I want my money out, this is real estate backed. How liquid is this? I don't think there's ever been a case where if somebody's asked for their funds back, that we haven't honored that within 30 days. In fact, just a quick scenario that happened 2 days ago. A long-time investor called me. He's concerned about what's going on in the world. And I stopped him right there. I go, you want your roughly 300K back? No problem. He's got his money back today. So it's within 2 days. So the liquidity hasn't been a concern in our 15 years of doing this. Defaults, they do happen. We deal with them, and that's why we have the relatively conservative loan to value on our deals. And this is a quick fact sheet of the overall portfolio. This is slightly dated. It's from December. We've moved up by about $8 million since then. This is in the information sheets. That's on your tables. There's more there. So we're always raising funds once a month. Our distributions on the first of every month. The minimum investment is $5,000. And you can talk to the DR, Cynthia, and Danielle if you'd like to invest. For more information, thank you for being here. Any questions?
Questions? Are there any questions? Does anyone have any questions? I will let you ask the question through the microphone.
Sorry, so if somebody wanted to use their TFSA,
Yep.
how would they utilize that? Is it through Olympia or something?
Exactly. We set up an account for you through Olympia, and the monthly distribution, we send them the documents, they send us the funds. It takes about a week's process. Yeah, through Olympia.
Any other questions? I have a few investors that couldn't attend tonight, and they've sent some questions, and I think their big one is, how does your conservative loan to value thresholds and real estate collateral translate into loss protection, specifically with property values declining?
Yeah. So obviously that's been a concern. Property values have declined, and hopefully we're at a plateau now. In some cases, condos have declined 20-25%, but we've never been big into condos. So the overall loan to value, as I said, is 62%. So we've got that roughly 38% cushion. And that's not all. Some deals might be 10%, 20% loan to value. The highest we'll go now is 75, but that's using current appraisals. We look at assessments. We take the lower one. We talk to realtors. What do you think this is worth? So I think our overall portfolio is fairly safe. We do evaluate it on a weekly basis. We look at any arrears, what's going on here. We do our own research and whether we need to put the borrower for a different borrower or start foreclosure procedure if we need to. It's a rare.
Thank you. And then just, if rates rise, I know your mortgages are shorter term, but if there's a big jump in the rates, how does that impact the return to the overall portfolio?
Yeah, so as you saw, I think it was 2 years ago, there was 11% return. And that was precisely because of the rates rising. So if the banks were charging more, we were also charging more. But that's not healthy for the borrower, to be honest, to be paying 11%. Ideally, 7 to 9% is ideal.
And that's also, the inflation was going up, and the Bank of Canada kept raising their rates, and we can all talk about politics here, but we had to adjust very quickly to the rate rise in 2022-ish, 3-ish. Our clients were happy. Mind you, but if you had a line of credit with Van City, which I did, I was paying 8%. So when people say, well, how can some of these people afford this? Well, I was paying 8% on $200,000 at that time. So there is that risk adjustment that we all have to take care of all the time.
Well, the reality is interest rates that were 4%, 3.5%, those were historically low. When I started buying real estate, interest So I guess right now our interest rates are still considered historically low. So I'm just, the biggest thing clients want to know when they look at a mortgage investment corporation is its ability to take over the property,
Yeah.
how fast they can do that, and to liquidate, to get the money out and protect the capital. That's a big one. And the second thing is, you know, how consistent have they been? And what I would say is that Metropoint has a very strong history of consistent performance. So that's what we're looking for today in the marketplace.
Yeah, you don't really want to take over properties. So that's the reason we stay. That's why we vet these borrowers. Where we do our due diligence is so strict that would be the last step,
Right.
Unless if there's something like just that they fell across hard times. We understand. You know, they still get the opportunity to sell that property at a certain price. You know, we're not there to dive in and take a property for $400,000. It doesn't work that way. And a lot of our investors assume that we can do that. Some of them assume that we'll take the property and we'll keep it for ourselves. We can't do that either. So it's very strict. You know, there are protections against for the borrowers too at the same time. You know, so we try to work with them before we're going to last
You're not
extreme.
property managers.
No, we're not. No, we're not.
And you know, if there's any questions on it, we're happy to take them after. And certainly, I think that from my perspective, having done this for about 15 years now, there's very few with this longevity and the consistency that Metropoint has, and I think that speaks to why we're doing this event. It's all about defensive strategies. I think everyone understands what's happening in the geopolitical world, and thankfully we have a ceasefire so that we can start not thinking what's going to happen tomorrow, maybe. So I think part of what we're trying to do is give you some good options if you're not certain of what's going to happen tomorrow. But thank you.
All right, thank you.
Time slot. It's tough bananas. You guys have one more in you? Yes?
Oh, yeah.
Oh, there's some spirit. I like that. Thank you. So again, honestly though, thank you all for taking the time to come out. I know your time is valuable, and we're going to do our best to give you some value in what we talk about today. So we're here today to talk about the exciting world of self-storage. I thought there'd be a couple woos there. I guess not. That's all right. That's all right. You know, I've thought long and hard about how to make this investment thesis sexy, and there really is just no way. It's just not. But when I talked to Danielle and Cynthia about the theme of today, you know, defensive strategies in the face of conventional public equity markets, I got excited, man. It's very fitting for what you guys are looking for today. So before we get going, I'm going to introduce us one more time. My name is Dennis Hedinger. I'm Executive Director for Form Asset Management. I'm based out of Vancouver, and I manage Western Canada.
I'm Candice Bassey. I'm the Executive Vice President of Finance. I manage all the valuations, finance, entire kind of finance team across Canada.
Brendan Clifford, EVP of Operations. Been with the company since 2018 when we had 2 assets. And as of 2 weeks, I think we're going to be close to 67 assets across the country. So been here since the beginning.
Hey, there's another woo. That's 2
All
woos
right.
in the first 2 minutes. That's pretty good. Anyways, today I want to be very succinct in what we say to you. So my point is to get 3 things across to you. One, I want you to have an understanding and hopefully a belief in the Canadian self-storage sector, how it's different than conventional real estate, how it's an early innings asset play in Canada, and how it can benefit you. Number 2, I want to introduce you and hopefully you get belief in form and make space. Danielle and Cynthia talked to me a lot about telling you guys about our expertise and our heritage. So hopefully that'll resonate and you'll have some trust in us. And then finally, I want you to understand our investment thesis and what we're doing in self-storage and how it differs from other people in the space. And hopefully you decide to partner up with us and come along for a ride. So how was that for an opening diatribe? Everyone gets it? Very good, that's pretty good. Okay, let's go slide number 1. So this is where I'm going to talk about us. I don't want to make this about us, but I think it's smart to set the stage of why you should listen to what we have to say. Form Asset Management has been around for 30 years. The interesting part about Forum is it started as balance sheet investors. So that's really us investing our own money in development, in projects, and investments. That's now morphed into a firm that manages $4 billion in Canada, and that's through developments in real estate, infrastructure, and private equity. We're headquartered in Toronto as well, proudly Canadian. I think that's pretty important these days. And how MakeSpace ties in, we always wanted to get into the self-storage business, but that's easier said than done. I look out here, probably, someone falls into some money that, I'm gonna buy self-storage. It's, printing money if I do that. But we'd say that's not the case. It's a very operationally intensive business. And because of that, we wanted to find the right partner. So in the early 2020s, we probably spent 18 months talking to MakeSpace. We found out what we had thought through our research, that they're best-in-class self-storage operators in Canada. We found out that they started in 2004. Their first self-storage facility was actually on Pender Harbor, so close to home. They now have 57 facilities across Canada, soon to be 64, it sounds like, if all goes well. They're also proudly Canadian-owned and are headquartered over in New Westminster. So what all that means is we found the right partner, we feel. And what you get through the Forum MakeSpace partnership is you get Forum's governance, our capital markets, our development, and our lending expertise. And then with MakeSpace, you get what we would say is some of the best self-storage operations in the country. So how's that for a big diatribe? Good? I think one other interesting aside, I was going to cut it out because I wanted to be succinct, and now I won't be. But I think it's important to say, because Forum started as balance sheet investors, we have a commitment that any investment that we put out to the open market, Forum MakeSpace commits to be the largest investor within that investment. So this particular fund we're going to talk about is about $250 million in assets under management. Forum and MakeSpace owners and employees have $41 million of our money in the same fund. I think that principal agent issue can be a problem sometimes in private investment, and we think that solves to it. We're on the journey with you. Okay, so that's enough about us. Do you guys have a painted picture? That's good news. I'll just briefly show this slide. You've all seen a risk-return slide. I think the point to take from this, 30 years of risk-adjusted returns. I want you to see that self-storage is a very consistent asset class in Canada. But this is what I think is exciting. So this is where I want to tell you about the Canadian self-storage asset class or universe that we're playing in. Some of these are pretty intuitive. I think I'll touch on the fragmented Canadian industry first. That's really important to me. So as I said, MakeSpace has 57 self-storage facilities in Canada. That makes us the 5th largest owner-operator of self-storage in Canada. If you look at what the entire universe is, there's 3,500 self-storage facilities in Canada. So you talk about a fragmented market, you talk about one that's due for some consolidation. We feel strongly that that's the case here. Maybe to put that another way, the top 10 self-storage owner-operators in Canada, they own about 18% of the market. If you juxtapose that to the US, which for better or worse, the US is usually 20 years ahead of us on the investment scheme of things, the top 10 owner-operators in the US own about 60% of the market. So we think there's early innings, baseball analogy, we're about in the top of the 3rd. Smaller new construction, you guys all get that. The Pier 4 guys talked about it. All new builds are multifamily. Why that's good for us and you if you invest with us is less garages, less basements. Smaller housing footprint, we all live in Vancouver. I don't need to tell you about that. Supply shortage, one interesting stat there. 2.5 square feet per capita of self-storage space in Canada. Juxtapose that to the US one more time. They have over 6 feet per square capita. So we're talking an early innings play, but I think most importantly, why is that defensive? So the infamous 6 Ds of self-storage returns. So density, displacement, downsizing, death, divorce, and disaster. The point I would make to you and what I really want to drive home today is none of these things are contingent on if the price of oil goes up and down, if there's a war in Iran or if there isn't a war in Iran, where the USD is going. All of these factors are self-contained and not riding the same economic cycle as most other investment vehicles that you'll see out there. One thing I think maybe Brendan or maybe Candace can touch on a little bit, our founder Vaughn always said that when someone is using our product, they're there because they're having a big life change. And so maybe Brendan or Candace, if you want to just speak to the empathy and customer service aspect there.
Yeah, like to speak to that, and we'll get into this a bit more, is like as operators, our number one, of course, we're here for our investors, but the way we do that, we really care about our customers. So customer service as operators is number one for us, and we keep that on the top of our mind, right? All the way from frontline store managers up to accounting team and executive office. Like, we want to ensure that our customers, customer service is number one.
And Brendan, maybe our response rate now, if someone sends a message in with our new systems?
Oh, yeah, go ahead.
Sorry, what was that?
Oh, just the AI response rate?
Oh, I mean, we've got, yeah, we can get into the operation. I can sit up here all day.
Yeah.
But, integrated call center, proprietary revenue management system. We're class leading when it comes to technology in Canada, even against the only REIT in Canada, which is Storage Vault, as well as the other 4 operators that are ahead of us. 24/7 call center. Hopefully that's answering your question there, Dennis.
No, that's great. Okay, so I set the theme of who for MakeSpace. I quickly talked on the self-storage sector in Canada, why we think it's a good opportunity. Now let's spend some time on what our investment thesis is. So it's pretty simple. I'll give it to you straightforward here. It's buying existing, already zoned self-storage facilities, usually from a sole proprietorship or a small partnership in secondary or tertiary markets across Canada, and adding our playbook on top of it. And that playbook can include a lot of things. We add technology on top, we optimize rents, we utilize extra land, we bring in SEO marketing, we bring in our portable storage facilities, and we make it very, very easy to rent and maintain a unit with us. So when we do that, and it's historically proven, we can add 15 to 25% NOI on those properties. So that's it. It's pretty simple. It's very fundamental. We'd say it's a simple playbook, but you need experts to handle the operation to execute. And that's what we think we do very well. So on that note, maybe I'll throw it over to Candace with a few questions about the fund and what we do. Candace, maybe last year is a good example. What was NOI growth and how did we look at that last year?
Yeah, so last year, same store NOI growth was 6%, and which resulted in a $14 million increase in value to the fund. And that is exactly through what David said, executing on our playbook and like using AI and technology to increase NOI and generate more customers.
Beautiful. And this pays a yield, yes, Candace?
Yeah, so Series B investment comes with DRIP distributions, and I think it was 2 times cash from operations last year.
Okay, and the daunting loan to value question. How do we finance and what's that number looking like right now?
Yeah, it's a good question. So as of right now, our loan to value is close to 52%, and that's strategic. So last year it was significant. Like at the beginning of last year, we were closer to 60. To get right to understanding the market, seeing what's out there, we've really focused on paying down, reducing our loan to value. And what we did is we've grown to a point now where we were able to go to tier 1 banks and get portfolio level financing. So we consolidated most of our debt across the fund into 2 large portfolio facilities, which also allowed us to gain access to line of credit. So we have line of credit of right now $4 million, and it will grow as we grow. And we don't utilize that, and we're that will be for acquisition. So we're looking at making sure we're liquid and prudent in our financing right now.
Nice. So a healthy balance sheet. That's good to hear. I'll show you this chart, and really the only reason I'll show it to you is you're not really beholden to one geography. You're spread across the country. think about makes, like I just had my first child last year, which is exciting, but that means I'm a Volvo family now. And I tell you that story because I never noticed Volvos anywhere, and now I drive around and I literally see them on every second block. I use that analogy because make space will be the same for you. There's a make space in Fremont, there's a make space in Ladysmith, there's a make space outside of the Victoria Airport, Fernie, BC, Estevan, Saskatchewan, Innisfail, Beaumont, outside of Edmonton. So if you take anything from today, you'll start seeing make spaces around. And if you start seeing them, you can be a part owner. And we think that's pretty exciting and tangible for a Canadian company solving a Canadian problem. So on that note, we're talking kind of top down. We thought we'd use Brendan and give you some bottom up examples, really, you know, how is the sausage made? So why don't we start, we have an example of Prince George where we have a large cluster. So Brendan, maybe I'd ask you, what did these properties or assets look like when we acquired them?
Yeah, so we bought these assets, we bought 2 stabilized self-storages in 2020. We also bought 2 parcels of vacant land. At the same time, we bought a portable fleet of about 200 portable containers. We were able to move that portable container fleet onto our own land, build a stabilized storage facility, and got a 2.3% value, times value over the course of 4 years, which is great. We're able to then kind of, I wouldn't say own the market, but we're able to push rates in that market. One thing in particular about self-storage, there is no rent control. So we can raise our tenants 1 year 25%, we could raise our tenants 2%. There is no rent control in self-storage, which allows us the versatility to play with rates in a market, specifically if we own the majority of assets in that market.
Maybe that's an interesting way to lead into turnover rate. I know that came up earlier today, and I think that's a big differentiator for self-storage. So maybe just speak to the turnover rate on the fund, and then we can drill a little deeper into it, Brendan.
Yeah, so our average tenancy across the portfolio is about 18 months. We get a 40% churn, which means that our median stay is about 9 months. Now, where this differs from residential is that if you have a location, an asset with 10 residential clients, if you lose one, you're losing 10% of your revenue for a month. We diversify that by having 1,000 units, 2,000 units in an asset. If you lose 50, you still have less percentage of revenue loss. So that's how we kind of diversify that.
Okay, and maybe a big one that...
De-risk it.
Yeah, de-risk. A big one I find super interesting is when we buy in these secondary markets, Prince George, Fernie, whatever it may be, all of these facilities come with excess land. So maybe an example of how we would utilize excess land, what it costs to put a CCAN down, what the return on investment is of something like that.
Yeah, so it's the small things, right, that add value to our properties. If you think about a parking space that we rent for a boat and RV, it's about 40 feet in length. Now we get roughly about $100 for that parking space every month. Now, if we can take that parking space, if we've got full occupancy and we know there's a demand for container storage, for example, we can remove that boat or that RV out of that 40-foot spot, put in 2 containers to rent. Each one of those containers is going to get us $200 and $250. So you've got 5 times your square foot rent for that same spot.
And so what does a CCAN run you, or a container?
So the cost of a CCAN is about $4,000. Your payback is less than 4 years on that asset.
There you go. Let's do some more interesting stories. Maybe we'll skip Winnipeg. Sorry if anyone's from Manitoba here.
Just sorry, if we got a couple seconds,
Yeah.
just on Winnipeg, I mean, it's a great example. We bought extra land, like you
Sure.
said. We were able to create 150 parking spots. We had the land rezoned. It was agricultural. We got it rezoned. We almost doubled the value of that property in 4 years as well.
Okay, and we'll go to something closer to home. If anyone here drives the Malahat, you'll have the privilege of seeing a make space as you go up towards that Cinnamon Bun in Ladysmith, right? I think an interesting thing to take here is a phenomenon that kind of happened in COVID with self-storage, in the fact that small business owners really started to utilize our units as their home base or their business address. So Brendan, maybe you can speak a little bit to what type of businesses are running out of there and how we catered to that business.
Yeah, I think it's a pattern we saw across the country. During COVID, we saw industrial rents, commercial rents rise. You take, for example, a local electrician, a small business electrician, small business plumber. They've got to pay $1,500, $2,000 to rent a commercial bay or an industrial bay to run their business out of. So what we saw, during 2020 and 2023 was we saw a lot of these small businesses actually pivot to self-storage. For the same price, they could rent 2 or 3 self-storage units and actually get more value for that, or they'd rent just one self-storage unit and spend half that monthly rent. So we've seen an influx of about 15-20% in commercial clients in the past 3 years.
And so we ended up starting to accept mail, so they can have that as their address. We can accept packages for them, and off they go. Be it a realtor putting signs out or a contractor picking up his gear for the day. How are we doing on time, everyone? People still enjoying our anecdotes here? We've got a ton of them. Self-storage all night if you want. Let's get back to how the fund functions, though, from a top-down level. Maybe I'll throw it over to Candace for a little bit of what did we do in this fund? How did we end up giving an 11.4 net return to clients in what was a very interesting, diplomatically interesting year for a lot of different markets in Canada. Candace?
Yeah, so our return last year, net return was 11.4%. And how did we do that? Well, we had 6% NOI growth. We also, focused on paying down high-level debt with our portfolio refinancing. We were able to reduce interest costs and fund level costs, and really put ourselves, give ourselves the ability to generate those returns. And we're targeting 10 to 15% for 2026.
Okay. One other interesting thing, and Danielle and Cynthia really stressed for us to show you, this particular fund only has a 2-odd-year history, but that's not to say Forum MakeSpace doesn't know how to manage money when it's in a fund structure. So these are 3 closed-ended funds that Forum MakeSpace had put out starting in 2019. These are all closed now, so that's net return, what you ended up to annualized to end client. Candace, maybe you can speak a little bit to MSCP1, how it started and where it ended up going.
Yeah, so I can speak a little bit to this slide and also to, I think it talks about our pipeline. So MSCP1 was the first fund that we created. It was a closed-ended fund back in 2014, I believe, or 2019. And MSCP1 crystallized and became an evergreen fund in 2024. And that's really the MSSF fund now. And MSCP2 and 3 were closed-ended funds that had assets that weren't quite stabilized, that had a higher risk profile, and we were able to stabilize them and generate those investors a return of 20% and 15%. And actually those were pipelines into our main fund. And we continue to do that. So we do have a strong pipeline of assets that we're stabilizing that will eventually end up in our main fund.
Yeah, both from the development side and the acquisition side.
Both from the development. Yeah, that's true. So we also, not spoken to here, but we also develop our own self-storages, which they're beautiful, and the goal is that they will end up in our main fund.
That's great. So I just want to drive home one more story here, just to show you who we're buying from and what putting an institutionalized process over these type of assets can do. Maybe Brendan can speak to it a little bit. We're currently looking at a cluster of assets outside of Hamilton. This is tens of millions of dollars for this cluster. And our CEO was out there speaking with the owner, and he's still functioning these 3 assets with a pencil and paper. He's got his buddy that he's been giving the same rate to for 10 years just because he's his buddy. And so if you can come in here and take away the pencil and paper, if you can optimize rates, utilize land, there's some green shoots in the self-storage industry in Canada. How did I tell that story, Brendan? Okay?
Yeah, no, that's good. That's
okay.
Good. To your point earlier, about 70% of self-storages in Canada are still owner-operated. So there's a huge consolidation play, which Dennis talked about. The owner-operators are very unsophisticated. You can imagine it's someone that has owned a self-storage for 15, 20 years. They're looking to exit for a life decision. That's typically where we step in, the secondary, tertiary markets. So we've got an active pipeline for acquisitions. We come in, we professionalize the business, we professionalize the operation. We put in revenue management, cost savings through staffing. As you can imagine, we have a centralized call center. That means we don't necessarily need to have 2 or 3 people on site. Through those processes and through that professionalism, we're able to increase the margins. So we sit at about a 30% expense ratio. And if you think about most other businesses, that's extremely low.
Okay. How are we for time, Sally? Did Sally leave all as well? Oh, nice. That's perfect. I have 2 minutes of material left, so that worked out swimmingly. You know, I'm going to close here. And really, we'd say it's people and process are what's important. That makes a successful investment firm. And we feel we have it here at Forum Makespace, and we're in the right place at the right time. You know, we talked about trust in Forum Makespace. This is some of the team up here, and I don't put them up here to name drop or anything like that. I say these people have joined Forum, and they put their reputations on the line to do so. You know, John Sullivan was the ex-CEO of Cadillac Fairview for a decade. Satish Ray ran OMERS, the second biggest pension plan in Canada, for 10 years. These people are not going to put their reputation at risk if they don't believe in what we're doing. And we feel like we have a pretty good thing going. Hopefully you have some belief in the self-storage sector as well. Strong secular tailwinds, underbuilt market in Canada. We have a strategy to buy, improve, and scale. And we're bringing institutional quality investment management here with very experienced operators and what we would hope to be aligned interests. So really in closing, this is a simple story executed well. And if you can execute well, that's usually where you're going to find your best returns. I think we'll end on that. Anything to add, Brendan or Candice, before we get a clap? Okay, thank you.
We will open up the floor if anybody has any questions as well. Any questions from the audience? There we go.
Where is your call center from?
The home center?
Where is the call center that you were talking about?
Oh, where's the call center from?
Based out of Woodbridge, Ontario, Vaughan, Ontario. Yeah, we have an inside sales team there, and then it's supported by a third party overseas. Yeah, no problem. And then our store managers will actually answer overflows if needed. So if someone's picking up the phone at any given time.
Dennis answered most of my questions. They're all crossed out, so that was great. We do usually always ask a few different things. So we talk about risk, and if you could outline your biggest risks of the strategy and what you're watching closely in the next year to 2 years.
Yeah, we were talking about that while we were sitting over there. Maybe I'll throw it over to Candice and Brendan here.
What was the question? Sorry. Go ahead. So sorry, what was the question? Just the risk.
I mean, some of the risks that have already been mentioned is there's always interest rate risk. So the way we have structured our debt is with the portfolio refinancing, we have, you know, we don't have anything maturing for the next couple of years, and everything is fixed, and it's maturing over a period of time. So we've worked to mitigate that risk, and then liquidity is always a risk that's been brought up today as well, and you know, we've worked to mitigate that risk in you know, prudent refinancing and ensuring that we have our line of credit available, which we do not use, and it's only for acquisitions.
No, I think you mentioned real estate.
Think about that TV show, Storage Wars.
Yes.
What kind of rate of delinquency do you have?
That's hilarious. I never knew that the TV show could make picking through garbage cool, right? It just blows my mind.
Actually, I'll speak to that. Yeah, we actually had Storage Wars at one of our locations. Believe it or not. Yeah. It's not as random as you may think it is. I'll leave it there.
Yeah.
Our delinquency rate is typically 0.75%. 0.075. Sorry.
What time period?
A tenant's lifetime. Yeah. So on average, 18 months on that tenant. Industry standard is about 1%. So we're just under. Yeah, collection process, we're in a unique situation again in self-storage where we can actually send those goods to auction to recover some of the delinquent funds.
So you sell it yourself?
We have a third party. You can't sell it yourself. We have a third party that sells it for us.
Oh, yeah.
And then the proceeds go to paying off that.
But you don't call in the producers of stuff?
No, unless you know somebody who'd be happy to do that.
And then just even the turnover, Brendan, on a unit, you go in there and sweep it out and call it a day, correct?
Correct, yeah, it's easy. And the 42% churn, I mean, that sounds like a lot, but what the advantage it gives us is that we can raise that rate on that vacant unit. And we have no rent control. So if we've got full occupancy on that rent, we were getting $100 because someone's been there for 3 years, we can now charge $400 if that's what the market's demanding.
And I would challenge you guys, you think about what is the biggest risk, how many of you here have a self-storage facility or a self-storage unit, correct? And what would have to happen in your life to stop using that, right? I can't see that many external mitigating factors for the use of self-storage to plummet in the near to midterm.
I think, Dennis, one of the things that stood out to me was you were talking a lot about how you're different and you focus on tertiary markets.
Yeah.
Many people associate self-storage with not having enough space and needing more space, and usually thinking about that in Toronto or Vancouver or major cities. How does that tie into the strategy of going after the tertiary markets?
Yeah. I'd say maybe twofold. Using an example is pretty useful here, I'd say. Brendan can come in too.
I can speak to
I'll
that
just,
really quick.
we'll just talk about, we bought a cluster of facilities in Trenton, Belleville, out in somewhat outskirts Ontario. It's interesting, when we were evaluating it, we use U-Haul data a lot. So U-Haul makes their data available. So we went up there, and the year we were looking to buy, we went one-way trip data. So Trenton and Belleville were in the top 5 in Canada for one-way U-Haul trips in. You also look, there's now a multi-billion-dollar expansion going on of the largest Air Force base in Canada there as well. So you talk about displacement, you talk about drift, like some of these things that are occurring. The demographic in that area are going to use a lot of outdoor vehicles, right?
Yeah, and to piggyback on that.
Yeah, go ahead.
We've got a development in the pipeline right now in St. Thomas, and for those that don't know, they've got one of the largest EV plants in Canadian history being built there. So it's acquisitions like that we're trying to hit before competitors are. The other point to being in the metros versus secondary, tertiary is that 20% consolidation we talk about. When you look around town here, you see about 4 or 5 brands of self-storage, and you know who they are: the Maple Leafs, the Public Storages, not Access out here, Sentinel, maybe SmartStop as well. The consolidation, that 20% consolidation, is typically in the metropolitan areas. It has not taken place in secondary and tertiary markets. So that's where we feel the opportunity is in the industry.
Fantastic. You talk about liquidity. Investors always want to know redemption schedules and time invested.
Sure. And so, small minimums, if any, I believe, on this Series B offering. Everything we do at Forum, and we got some pushback at Forum MakeSpace years ago, we've always had a soft lock. And that gives you monthly liquidity, T plus 60 for cash to account. Again, you're owning buildings here, so there are some maximums per month. But yeah, T plus 60. Shoot, I lost my thought there.
Yeah, I can add to it.
Oh yeah. Sorry. The soft lock. It's a 5-year soft lock. So if you sell within year 1, it's 7% of NAV, 6, 5, 4, 3% of NAV, year 1 through 5. The thing I'd say there, that fee does not come to Forum MakeSpace. That fee is shared with investors. So if you choose to leave early, that's another way to provide a liquidity buffer to the investors that have stuck with us.
Sally, anybody have any other questions from the crowd?
I can add, we also have, we aren't gatekeeping our redemptions, and we haven't really seen many redemptions in this fund.
Yeah, we had a solidly net positive year last year, and see no reason for that to not continue moving forward.
So no gating redemptions for anybody who's heard that going on in some of the industry. Yeah. Okay. So for anybody here newer to private markets, what would you want to leave them with here to help them understand?
Oh, what a sweeping statement, Daniel.
I know. What's your last comment that we haven't answered yet?
It's we're serving a purpose. There's really only one way to get Canadian self-storage exposure without Forum and MakeSpace, and that's the Storage Vault public REIT that's available on the TSX. Other than that, we're the way to get pure play Canadian self-storage exposure. I think it's a tangible thing that you guys all understand. You see why people use it, and I don't see it moving the same way as a U.S. equity market or a U.S. dollar or whatever it may be. And I think that's what people are looking for these days. So don't put your whole portfolio into it, but some of it is nice. Any finishing thoughts here, Brendan?
No,
Candace?
That's great, Dennis. Yeah.
I also want to add that, as an investor in our fund, we've been told best-in-class reporting to investors quarterly, which has, you know, reporting from operations, accounting, like basically our whole team. So you can see what we're doing and you can follow along on the journey and ask questions whenever you have,
Right.
whenever they come up.
I think that's where we should finish on.
Yeah.
It's a journey, right, within our investors.
Yeah,
So.
yeah. We take our partners seriously, and you're a part owner along with us. So if you choose to join us, you know, you ever want to go tour a self-storage facility in Fernie or Estevan, Saskatchewan, we'll line that up for you. You got. Yeah. Hey, yeah, we'll have some Pilsners, right? Yeah, Fernie's good too. Anyways, thanks for everything, everyone.
So this will be probably about 5 minutes, and then we're going to do a draw for the door prize. And we have the room for a little bit longer for anybody that wants to have another drink or hang out or ask any questions. So who is Parvis and what do we do? Parvis is the infrastructure behind what you're seeing tonight. They facilitate access, compliance, onboarding, and due diligence. They enable access to all of the funds that have been presented here. Parvis was founded to fill a gap in the market and provide broader access to private investing. So we are very unique in the marketplace, and that's our mission. We are an exempt market dealer, so we are regulated to provide these funds. Cynthia and myself are dealing representatives, so we are independent of the EMD, and we are here to serve you as a client, have your best interest in mind, identify risks, look at your suitability, and figure out what is a good investment for you. We help investors add private equity to their portfolios, perform independent due diligence, and the goal is to democratize private markets for a retail investor like yourself. So expanding access to institutional quality private equity. We do that through institutional opportunities, strong legal structures, aligned your goals and risks together with what you're investing in, and all of our target returns are net of fees. I've had that question a few times tonight. So there's transparent cost on what the funds are, but as you as an investor, when you see a targeted return, that's net of fees and that's a target return to you. So our platform is very unique as well. Parvis is a tech company. You'll notice when you go on our website, if you've been there before or haven't ventured there yet, we have 40 to 60 different funds available. These are 3 of what we have in our portfolio. We like to streamline the investing, let you know how the target returns are outlined. You can come onto the site, you can filter by registered funds, minimum investments, things that are fitting what your strategy is at the moment. So hit on most of those points there. This is how we help the investor understand all the funds that we have. They're customized strategies. So tonight we've seen 3 of the strategies, fixed income, core plus, and value add, adding to the defensive strategy that we are pulling together tonight. We also have opportunistic funds. That might be something like a development fund, higher risks, higher returns, but those are available as well. So lots available through Parvis. More accessible. So few people understand how private investments work. Our goal with the presentation is to provide clarity, confidence, and connection here tonight and facilitate questions that you have and help educate you on how to add this to your portfolio. So why diversification is important. It's some of the theme that we have tonight beyond the stock market and having a defensive strategy, strengthening your core portfolio, avoiding concentration risk, market behavior and balance, reducing volatility, and expanding growth potential. This one here. So tonight is all about the structure and the process. The private markets are evolving, and again, our goal is to make that more accessible, transparent, and clear to all of our investors. So similar to this, we just talked about a case for the modern private markets, why we're proposing this in addition to or as an alternative to stocks, bonds, and cash. Private equity investments are less liquid. We talked about a redemption schedule and liquidity. Sometimes there are minimum investment periods. And the reason why those are in place is there's often an asset management plan behind the scenes. So you're buying into an asset management plan. The plan is to have that money for a certain amount of time, and it's beneficial to the fund for that to happen. There are options to redeem early and get out, but the benefit of having these less liquid is that they're also not subject to the day-to-day market swings, as was outlined in some of the presentations. So private market investment structures. There are a few that we have with all of the investments on our shelf. The ones that are here tonight, private REITs and real estate funds with Pier 4 and Forum. They own and operate portfolios, not publicly traded, provide regular income distributions, and are backed by real assets. The MetroPoint is a MIC, Mortgage Investment Corporation. They pool investors' capital together and loan that to developers or property owners, generally have a steady interest-based income, and are also secured by real assets. So all of the funds here tonight are secured by real assets. We get this question a lot as well. So as you're looking at our funds, there is often a designation of who can invest. This is the investor accreditation. So it exists to protect investors and support suitability, aligns with product types with investors' interests. So we go through a process with you in the discovery call, and if you were to invest, to go through where you are at with your situation and suggest something that aligns with your goals. So there's two main types of investors, eligible and accredited. I'll list off what this is here so you're aware. One thing that's often misunderstood is what net financial assets are and what that means. So it's all of your total liquid investments and cash, minus any outstanding debts. So that's how we get to that number for the qualification here. It excludes personal assets like your home and your car, which is often misunderstood. When you do sign up to the profile and make an account, we have a nice way to fill out all this information, and it quantifies all of this for you, so you don't have to do the math if you don't have it ready. But we like to make you aware of what these are so that when you are browsing the site or looking at these particular investments, you know where you fall. So eligible investors are someone that has $75,000 annual income or $125,000 combined with a spouse and $400,000 in net financial assets. Accredited investors are $200,000 annual income, $300,000 combined, $1 million net financial assets, and $5 million in total assets. So some of what we do, Cynthia and myself, as dealing representatives, is we'll walk you through this and we'll help you figure out where you lie. Risk consideration. So again, suitability is a big part of it. We want to make sure this works for you. It's not for everybody. Private equity is a great option. It makes up a smaller portion of your portfolio. Target returns are just that. They're targeted. There's no guarantee there. So we do put out a targeted return. Why we've chosen the funds that we have tonight is they do have a long history, a track record of returns. We like to see that in the funds that we focus on. And I've made this short, so I haven't read through my slides because I know it's been a longer evening. But this one here, so in a closing, so at the beginning, Cynthia shared a story about a spark. Our hope is that something sparked for you tonight. We encourage you to stay connected and continue the conversation. When something sparks, we feel like the next step in action should be taken. If you would like to book a discovery call with Cynthia or myself, you can scan this code here. There's a couple at the back of the room as well, and it's open to our calendar, and we can book a discovery call with you and go through the next steps. So again, thank you for being here tonight. Please take your time in the room, and thank you for coming.